Hi, my name is Dan Fowler. I'm past president, current chairman of the Apartment Owners Association of California, one of the largest individually organized groups of apartment owners in the state. We're going to ask you to do something today for the industry and for yourself. As you know, the moratoriums have been extended, and they will probably be extended again after this, and again, unless you and I do something about it. And I'm going to ask you to do something today to join together in one of the largest protests of these moratorium and the stealing of our property, forcing us to provide welfare for others, forced welfare for others that we hardly even know. But yet the politicians are sitting there and giving our money away, giving your retirement funds away, just like taking their own 401ks and saying, oh, we're going to take all your money and we're going to distribute it to tenants. Or let's take the politicians' retirement fund and let's distribute that to the tenants. That's what they're doing to us. And it's got to stop, and it's got to stop now. And this is the way we can do it. Join together in the largest property owners protest ever. You say, Dan, I'm not going to go out in the street. I'm not going to burn down buildings and do all that stuff. We're not asking you to do that. We're asking you to do it out of the comfort of your home. Send a picture. And here's the picture I'd like to ask all of you to send. There's a picture and a letter, but get the picture. Send that to the governor. We've got the governor's address on the letter there that you can copy. You're going to send the picture, and you can send a copy, and except at the bottom, you're going to sign this letter, or at the just underneath the picture that you have there, you see, you can write in, tell them about the problems that you're having and why it's unfair. Of course, pretty much the signs tell them why it's unfair to do what they're doing to us, and ask them to stop. And also send the letter in to the governor. We're asking you first to send it to the governor, and then after you do that, all of us will send it to the, say, Dan, and I hear this all the time, it's not going to do any good for me to send in one letter. He's not going to read it. No, but if thousands of us, and we have over 20,000 members, if thousands of us out there and apartment owners will send these letters in and send this picture in, they're going to read one of them. Now, you can also send these to your mayor of your city and the city council, the board of supervisors that you have. You say, Dan, I don't have their name, I don't have their address, and we're going to give that to you right here on the screen so that you will know where to send your letters. And if you will go to, if you'll put it up on the screen, on the copy of, there we go, copy the link below. If you'll screen that, those of you that are on YouTube, if you'll screen down from where you are, you'll be able to click through to the AOAusa.com/protest pictures and letters.pdf. Or if you're watching on the AOA website, if you'll click that in on your computer, it'll take you to the letter and the protest picture that you'll be able to download on your computer. Download those, make a bunch of copies, send them to as many politicians as you can. If you will Google, you say, my city council member, I don't know them. If you'll Google your town, like San Francisco, California Assembly members, if you want the assembly members. If you want the city council, you would Google San Francisco City Council members, enter it, and it'll show you who they are and also their mailing address. And you can copy, again, this picture and copy the letter if you'd like to send the letter, but definitely send that picture in. If we get thousands of these sent in, this will be the biggest protest that they have ever seen, and it will be a silent protest. It will be a professional protest, and they will look at it. And if you have time to phone them, again, on where you're clicking through, you'll be able to find phone numbers. We're going to ask you to do that. Folks, they want your building. And that's what they're doing now. They're taking your building. You don't have that building if you have a tenant that's not paying. You don't have it. They have it. They have control of it. They're telling you what to do. And so we've got to put, again, a stop to this. And we've got to talk to the governor. He's already talked about reimbursing all the rents for low-income tenants. We have high-income tenants, too, a lot of them. And we need to be reimbursed for their rent that they have passed. And many of them didn't deserve to do it. They didn't have anything to do with COVID on it. But we want that money back, and you want to tell them, reimburse us for this money. One city has already purchased about 20 buildings. Cities are looking at taking a first right of refusal. In other words, if you're going to sell your building, the city wants the right to buy it, or they'll give it to a nonprofit organization, and they'll have the right to buy it. It's going to ruin the value that you'll be able to get out of your company. Please join us today. Join together with all the other owners, and let's make this the biggest ever protest that's ever taken place. I'd like to introduce you to Jeff Fowler, President of the Apartment Owners Association, to take over the program now. Thank you very much, and thank you for helping out preserve the value of your property and also other apartment owners. Thank you.
Welcome, everybody. Thank you so much for being with us today. Again, we have Sara and Adam with us. It's going to be great. H&S Wealth, and they're our sponsor today, along with the AOA Brokerage, and they're going to bring you some timely updates and share more about 1031 exchanges with you. So it's going to be great. Last week, you may have missed it. I don't know if you did or not, but we had a walkthrough on the AOA walkthrough forms. Anyway, we did that, and then we also had how to save big with AOA group insurance. That was last week. If you missed it, it's probably because you're not subscribed. So we want you to subscribe to the YouTube channel. We want you to get on the email list that we have, and we're going to always, with that list, we're going to send out things just to keep you in the know on what's happening legally and just different opportunities that are out there. And of course, the updates on the live streams. And you can always register for the live streams, or just look on the AOAUSA.com website to see what live streams are coming up. And this afternoon, 1 o'clock, we do have Dennis Block. Eviction moratorium in LA City was just extended, as you heard. And so Dennis will be with us and sharing a legislative update and lots of helpful tips for where we are at today. And on the 15th, it's going to be great. We have Carla Dennis, CPA, and she's going to tell you, I love the title, What Does Joe Biden's Tax Plan Look Like for You and Your Money? That is the title, and she will help you save money if you take her advice. Anyway, so it's going to be good. You'll want to listen in on that, get ideas, and take those back to your own CPA or user, either way. And so that's going to be really, really good. And for today also, we have the little help button. If you're watching on AOAUSA.com, you'll click on that and you can type in your question for today. So without further ado, I'm going to introduce our first speaker. She's been working with AOA Brokerage for over 10 years. She started as a transaction coordinator, so she's really good with the details, and now she's a real estate agent. And she has experience selling things from single-family homes she's been involved with all the way up to 100-plus units. And so she's going to bring us a short message and then introduce our main speaker. It's my pleasure to introduce to you today Sara Ianni.
Hello, everybody. Thank you very, very much, Jeff, for that introduction. I appreciate that very much. It's so exciting and such an honor to be here today on this side of the camera. Like you said, my name is Sara Ianni. I am a real estate agent with AOA Commercial Brokerage. AOA Commercial Brokerage has been servicing apartment owners for the past 40 years. We are a full-service apartment brokerage, and we are located in the Apartment Owners Association. My office is located in the main office at AOA. I've spoken to many members, and some of them are unaware that there's even an in-house brokerage at AOA. We've been around for over 40 years, so, we've been around. If for any reason you need to deal with a brokerage department that you need to trust, go ahead and call AOA, ask for Sara in brokerage, and they'll transfer you right over. Also, our contact information will be displayed on the lower portion of the screen. I would suggest to just go ahead and write that down. Keep it handy in your notes. So for any reason, if you need to talk to me or another real estate agent, go ahead and just call us, and we'll be happy to help you out. So just real quick, I'm just going to mention, we all know that this is a seller's market. We all know that this is an unusual time in the market. You really don't need me to tell you that. If you currently own properties right now, you may even be getting offers straight from investors. And maybe that's how you get a little indication as to what your property is worth. As an apartment owner, I would say maybe get a second opinion. Go ahead and call us. Let us evaluate what your building is worth. We are for the apartment owners, and we're here. So just if it is the right time, and if the numbers do make sense, we would love to work with you going forward in whatever you are moving with your building. But I would suggest definitely, if you're getting offers from other investors and this is the right time, call us first and let us just decide what the true value is of your building. So to properly determine the value of your building, there's so many different variables going on in the market right now. I'd say that each building might have its own unique value. So for that, it's essential for us to have a little conversation prior to determining that value. We're not just going to look up on websites or on a market value. We're going to do a specific property evaluation. So it's essential to have a little conversation prior. That's why I suggest, write down my contact information, the brokerage contact information. Go ahead and utilize that. So whatever it is that you're planning to do, there's many different things that you could be planning. You might be ready to what we call cash out and just pay the taxes and move on with your life. You might be wondering how you can still, manage income and maybe even generate more income, which is you might want to invest in a DST, Delaware Statutory Trust, which is what Adam is going to speak about later on today. Whatever it is that you're deciding to do, the first step is to determine the value of your property, and that's where I can help you. Now, as AOA has mentioned many times, the main goal here at Apartment Owners Association is that you will discover at least one idea that'll help you make and or keep more money than ever before. And if you're contemplating the possible sale of your apartment building, you may be aware that you face an enormous tax bite, and that's the bad news. But the good news is that there are different strategies and plans in place that you could utilize that can get you to avoid or defer those taxes. And that's what Adam Bryan is going to be speaking to you about. Adam Bryan has been in the 1031 tax exchange, DST, investment industry for many years, since 2002, I believe, and he'll tell you more about himself in the next coming up section. And so that's it for me. Thank you very much. And like I mentioned, we are here. We are AOA Commercial Brokerage in the Apartment Owners Association main office. So for any reason, if you need a real estate agent, call AOA and ask for the brokerage department.
Sara, I appreciate it. Going to talk a little bit today about what's happening in the tax environment, how it's going to affect us here in Southern California, what's happening in Washington. We've already heard about a pretty dramatic change that just occurred today. The moratorium on evictions ordered by the CDC was just extended. And at this point, we don't know how long that extension will go to. But if you were planning on completing a unlawful detainer and getting some tenants out that were not paying their rent, you're not going to be able to, at least for the next 30 days, if not longer. It's unfortunate, but that's just the cards that we've been dealt. I'm going to talk about a few things today with regard to taxes and with regard to 1031 exchange. First of all, I like to say, at this point in time, nobody really knows anything. In other words, there's been no final bills submitted. Congress has not voted on them. We don't know what the end result will be. We know what the proposals have been, and we know where the members of Congress have, at least publicly, been stating where they stand. So I want to cover a few things. I've been very close to this since the 2020 campaign, actually, paying very close attention to what the candidates at the time were proposing, and specifically Biden, who eventually, of course, won. The first thing is that there was talk about a wealth tax. We all might have heard that. That would be to say that the government would tax you on your net wealth, even if you haven't experienced or realized a gain. I personally think that's probably not very practical. How can you tax someone on their Apple stock when it could drop the next day? And I can tell you with some confidence, and at least based on all the statements that have been made publicly and put in writing on the campaign and now the White House website, that the Biden administration has not supported that. So fortunately, all of this could change, as I said originally, but fortunately that's not an initiative that we've seen from either the Democratic Congress or the Biden administration. There are many things that the Congress can do in the next year and a half with regard to any tax or spending. That's through what's called budget reconciliation. We hear about that a lot. And essentially, if all the Democrats lined up, which isn't necessarily going to happen, with the vice president's vote, they can get through virtually anything they choose to, as long as they're all aligned. But it must pertain to tax and spending specifically. There are a couple more opportunities for the Biden administration to use budget reconciliation. They used it once for the COVID bailout, and they have one opportunity every fiscal year. The 2019 fiscal year was actually used for the COVID bailout. If that sounds odd, it's because the Trump administration did not complete its budget, so they were able to take advantage of that. There are two more opportunities between now and when the Congress may change in 2 years or in a year and a half to use budget reconciliation. Corporate tax we've heard a lot about. Where we started was essentially in the 30s under the Obama administration, almost 39%. The Tax and Jobs Act of 2018 lowered it to 22, and as you've probably been hearing, there's some talk about increasing it perhaps up to 28% or less. Again, we don't know what'll happen, but that was what was proposed. Joe Manchin, the Democratic senator, has been opposed to raising it that much publicly, he stated. We don't know, but undoubtedly there'll be an impact on corporations in the next few years, possibly through the use of budget reconciliation. We don't know, but it might likely end up at least 26 to 28% from today's 22, where it's been the last 2 years. Let's see, top income. So if your income, you're at the highest bracket, it was lowered to 37%, again under the Tax and Jobs Act of 2018. Biden administration's proposed to returning it where it was under both Obama and actually W. Bush as well at 29.6%, so a 2.5% increase. That's on the top earnings that you have that are reported. Capital gains. There has been talk about taking both qualified dividend income and capital gains, such as when you sell your apartment building, and taxing it at that highest income rate. Right now, the highest rate for capital gains to the federal government is 20%, plus an additional 3.8% Medicare tax. California, it varies, but you're probably landing, you could be as high as 13.3, maybe around 10 or 11%, and then the recapture of depreciation. What the Biden administration has proposed is to tax that capital gain as if it were ordinary income, and that would therefore put you into that 39.6% plus the 3.8% Medicare, and of course regular state income tax. So it's going to take away nearly half of your gain in federal and state taxes when and if you sell an appreciated asset. 1031 exchanges. This is interesting because it's the only change that the Biden administration has made since the campaign as far as what they've proposed. They've been fairly consistent on supporting things that they said they would support, changing things that they said they could change, they would change if they could. Nothing too dramatic happened since the election until about April 28th, with the latest Biden administration proposed extension of the COVID bailout, I'll call it, which includes many things, including the infrastructure, again, that you're hearing about on the news. To pay for that package, the Biden administration said, why don't we take capital gains that are $501,000 or greater, or $500,000 and greater, and no longer allow tax deferral. And that's very significant for 1031 exchange investors. So if you bought the property for $100,000, you sold it for $600,000. I'm oversimplifying, but that $500,000 profit or capital gain could continue under this proposal to be deferred, just like a normal 1031 exchange that you've already done perhaps in the past and are familiar with. But every dollar above that 500 would be subject to capital gains tax. That was not in the original plan. The original plan was that anyone with earnings over $400,000 in the prior year, presumably, it was not defined, would not be able to exchange at all. And last time I was talking about this with you, I was pretty confident that even my wealthiest clients and many of you watching, the members here, don't generally have 400,000 in gross income, adjusted gross. It's just a very high amount, and most people are able to keep their actual income relatively low, regardless of their wealth or their real estate. It's one of the advantages of real estate that you can shelter your income. So my confidence was pretty high at that point, although I did say things could change, that it's not going to impact very many of you, relatively speaking. Well, now many of you have assets that have appreciated more than 500,000. And again, very few of you have that high income. So there's a disparity here. This is a big significant change in the proposal. But let me reiterate, it was a proposal. It was issued, I believe, April 28th, with the last proposal from the Biden administration. So far, it hasn't been written into a bill. Once they look at it, they're going to realize, undoubtedly, it's going to impact a lot of taxpayers with significantly less income annually. It's going to hurt a lot of people. Whether they'll go forward with that, it's entirely possible. I can't say they won't. But what is significant, it's the only change that I'm aware of pertaining to these tax laws I'm discussing from the campaign, meaning there was suddenly, my belief is that they suddenly looked at how expensive these things are and how difficult it is to get things passed, and perhaps it's a negotiating tact. But we can pontificate all day. What will happen, and you've got to make your decisions about your portfolio and your real estate, again, based on the cards that were dealt. But if you're trying to track what's going to happen and project what you think will happen, these are just the things that are being discussed right now. I can tell you I've been in the industry. I'm with H&S Wealth Management. I worked for a couple of other firms going back to 2002, and I know there were two significant challenges to 1031 in general, both under the Obama administration and the W. Bush administration, never made it to a bill, and certainly never made it to a vote on the floor, therefore. Why? Because it doesn't make sense. When you look at the numbers, you look at the amount of people who end up not deferring and then paying taxes today, wisely or unwisely, there's very little gain to be had. But if the Congress changed significantly the 1031 laws, I believe that will inhibit people from selling. It'll slow down transactional velocity and could have a very negative impact, ironically creating less tax revenue for the government to tax than they're already collecting today. Again, just my experience and my opinion, but those are the facts, those are the numbers. And so as a result, my hope is that nothing happens to 1031, but it might. I can't tell you that it won't. So let me go into a little more detail on the timing, since we're here to talk about the market. As Sara said, extremely hot market right now. There is a huge disparity between the traditional supply and demand. There are X number of buyers and investors out there that are looking to own real estate. They want a hard asset. They want an inflation hedge, because you can always raise rents with inflation, unlike other investment classes. There are new homeowners, or rather new first-time homeowners or buyers that are out there. One of the great things I always say about this country is we keep making babies, which means there's new taxpayers and new consumers and new investors born every day. As a result of this sort of natural growth, the problem is that between COVID, uncertainty about the tax law, the inability to evict non-paying tenants, and a variety of things that are happening right now, people aren't selling. And we realize that. Does that mean it's going to stay that way? Well, of course, no. I think things will adjust and kind of normalize. But there is a huge disparity between buyers and sellers, and as we all kind of instinctively know, when you have a lot of buyers chasing relatively few properties, prices go up. That being said, it makes it a really good time to be a seller. I would argue the best time in history to date. Should you sell? That's the big question. Well, I always tell investors and clients it's a personal decision. There's a different question of where we are in the market cycle. Is it a good time to sell based on where we may be 6 months or a year from now? But that's a different question of, is it a good time for you to sell? In other words, we may be at the top of the market, and yet your tenants have been paying rent. You like your investment real estate. You're fine holding it for the next 5 or 10 years, come what may. That's okay. I'm not here to tell you you need to sell, absolutely. What I can tell you is between regulation, particularly in Southern California, where the majority of the folks, and Northern Cal that I'm talking to, there's a lot of uncertainty as to what could happen. Rent control initiatives could be put in place. A worst case scenario, as I said, with 1031 tax law changing, not favoring investors, many things could trigger a real need to kind of get out or take the cards off the table and sell. And if that makes sense in your timing and your life and your retirement perhaps, we would help you with finding a replacement property. Because in the end, anybody who's considering selling and doing a 1031 exchange has to ask themselves, what am I going to buy? It's great to be a seller, but now's not a great time to be a buyer, whether it's in San Francisco or the Inland Empire or certainly in Southern California. So what I would say is look at your own situation. Prices have risen dramatically higher, looking at inflation-adjusted numbers from about 20 years ago. There's a study done, this was specifically LA County, but it's even worse in Northern Cal and the Bay Area, and that is that if you took the average rent that people were paying in the year 2000 and compared it to 2017, obviously it's changed a bit since then, the overall rent that was collected, adjusted for inflation, so equal dollars, went up about 32%, went up dramatically. So people were basically paying more now than they would have then for that same two-bedroom in Brentwood or what have you. Interestingly, they also compared it to the wages that were earned on average in LA County, and again, wages are higher in the Bay Area. How much did they rise in that 17-year period? Rent went up 32% for the same unit. What happened to that income for that tenant? And at that point, it had dropped 2%. People were making less money, but paying 30% more for rent. That means that there was a disconnect between the amount of income people were bringing in and the expenses they were paid, particularly for living. Now, between 2017 and 2021, we've caught up a little bit. There has been some increase in wages, but that said, there's also been, as you all know, as landlords, an increase in rent. When you have that kind of disconnect, if you're charging, in other words, arguably the highest market rent that you can collect, and people are paying, in this case, maybe over 50% of what they take home in wages, you can't keep raising rent, right? I mean, at some point. Now, I know many of you have not kept up your rents to market rates, so they're far more reasonable. But when you do get to that point, as you should, of charging the top dollar you can for your units, well, right now, people just aren't earning enough to pay a whole lot more. There's still some room to grow, but there's a pretty substantial disconnect there. So what does that mean? Well, properties are evaluated. When you talk to Sara, and she's going to look at your property and look at the income and the expenses, that's going to help dictate, along, of course, with location, what the value of your real estate is. What's the gross rent multiplier some people use, or GRM, or what's the cap rate, CAP, or capitalization rate. It's a multiple of the income, right? So if you're charging market rents, depending on what people are willing to pay in a given market, that's going to increase your value the higher your rents are. Well, if we can't raise the rents, we can't increase the value. And that's why I say I believe we're getting towards the top of the market. We can't keep rising because wages aren't high enough. And so therefore, maybe now is a good time to sell. That doesn't mean it's going to drop dramatically. Some people believe that. We'll see. Remains to be seen. But what I can tell you is that we are at a point, I think, where it's going to be very hard to increase income or revenue on an investment property. This applies to commercial property as well, a little bit different than multifamily. But nonetheless, if we can't do that, then unless people are willing to pay more for less income, you're not going to see more appreciation in your real estate. And arguably, you're pretty high right now and not a lot more room to grow. So if it's your time in your life, in your ownership of real estate, in your portfolio, you want to sell your asset and maybe take some chips off the table. I know in my life personally, we've considered selling not an investment property, but my residence, simply because it's appreciated so dramatically and relatively suddenly, just over the months of COVID, in fact. I've had double-digit increase in value. So we had to think about, well, maybe we should sell, and guess what? So far, we're not selling, not unlike everyone else. There's not a lot of properties out there that are available. That being said, if you're going to sell, you have a couple of options. You can, number one, pay the tax. And as I mentioned right now, you have a maximum with the feds of 23.8 in total, and whatever your state income is, and 25% depreciation. Pretty big tax bite, always has been. The other option is to do a 1031 exchange. And as most of you know, but I'll just briefly recap, you sell your property. The IRS says you need to move the funds with an accommodator, a third party to hold the funds, kind of like a second escrow. You have 45 days from the close of your sale escrow to identify what you're going to purchase. And you have to actually close on those purchases or that purchase in 180 days. Very strict timeline. The problem is, what are you going to buy? In other words, if you just sold in Southern California, as I've said several times, great time to be a seller, it's very hard to find a property that makes financial sense and that you have a willing seller. Probably going out of state is an option, but a lot of people don't want to be an absentee landlord. So most people say that's the end of the story. If I sell, I'm going to pay a huge tax. We don't know when and if they change the tax law, what the timing will be. Another slight change in the Biden administration's proposals was to backdate any change in the 1031 rule, the one about 500,000 gain or better, in order to catch people who might rush to sell. That generally has not happened. There was a court case many years ago where the Congress wanted to change something and they took it to the Supreme Court and retroactively changed something, and the Supreme Court supported it. So it is legal. It has been tested. But generally, it's almost never been done, not unless it's a credit that benefits taxpayers, has it been backdated or retroactive. In that April 28th proposal, the Biden administration wanted to go back to second quarter or April 1st, 2021. Anybody who sold from then, about 2 months ago now, to the end of the year would be subject to that change if he could get the change through. And that was pretty significant as well. But as I mentioned earlier, none of that's happened. It's very early in the proposal stage. We just don't know. But a lot of folks may decide to sell now and end up paying the tax at a relatively lower amount. And that may make sense as well. I'm not here to tell you shouldn't do that. It depends on your portfolio and your need for liquidity and so forth. But my point is that's usually the end of the story. Pay my pretty substantial taxes, which might even be higher soon, or buy something local that's going to be exorbitantly expensive. And they make the decision based on that. Very savvy real estate investors do this. I've been doing this 19 years. And often when I talk about the third option, it's news to them, maybe news to you today. And that third option is called a Delaware Statutory Trust, or DST. Let me explain to you what that is. It's not new, but it's also not widely promoted. So H&S Wealth Management has been offering these co-owned, and they are fractional ownership investments. For many years we've worked with investors. And it's been around. It's sold as an investment security, so you have to have $1 million net worth or greater to invest in these kinds of properties. And they're designed to be passive investments so that you're not having to manage the day-to-day. That's a large part of the appeal. They also tend to be, again, out of state where the prices are much more reasonable and the income that you can get from the property is much more reasonable. And it's not new, it's just not widely promoted. I'm allowed to educate investors about it. That's what we're doing today. But we're not out there specifically selling individual offerings like a listing. That's not permitted by the SEC for this type of investment. So that's why you may not have heard about it. That's why we work with Sara and the brokerage, because there's a natural fit there. If an investor doesn't want to buy a new piece of real estate that Sara can find for them once she's sold their property, she can refer them to us and we have a solution. What is it exactly? It's a little confusing. This is they'll bring up the screen here. This is what they look like. These are institutional, we use that term, very large properties, 50, 100 million, usually single assets, although you can have multiple physical properties in a single DST. And as you see here, we favor primarily multifamily and not just any apartments, Class A, newer apartments, if not brand new, and I'll speak to that in a minute. You would own, potentially, you would be able to do a 1031 exchange and own perhaps 1% of one of these properties. So obviously you're not in charge of managing everything, hiring the vendors, dealing with the tenants and so forth. You would have the luxury of being able to kind of sit back. What will happen is that a sponsor, think of it as a real estate investment and management company, they scour the country. They go and try to find the best investment opportunities. They literally look through hundreds of deals before they're able to get to any individual acquisition. A DST can be any kind of real estate as long as it's held for investment purposes. That's why the IRS allows it. It's the same as owning a property on your own. You just own 1% of it. You have to identify it within 45 days and close in 180, just like normal. And it has to be held for investment purposes. Again, just like normal 1031. It doesn't change the tax law. It's just a different option of what you can buy. Every acquisition that these real estate sponsors complete, they create a new Delaware trust. So for those of you that are wondering, is it a REIT or a pool of properties? No, it's an individual asset, or sometimes several assets rolled into one. But it is literally a new offering or a new entity with every acquisition. That's important because that means you're not buying 1,000 properties. You're literally buying into a specific asset or assets. They form this legal entity in the state of Delaware. Like many corporations, very favorable tax laws in Delaware. That's why it's called a Delaware statutory trust. The sponsor acquires the property with their own capital, with their own money or their own lines of credit. Normally, there's a loan, a very conservative loan. By conservative, I mean 55% loan to value, 50 or 45% cash going into these offerings. So this is not like in the early mid-2000s where there was far too much leverage buying properties, banks' money, fake money, if you will. These are real hard capital. They will arrange that loan in the name of the DST. They will acquire the property, and the deeded interest on the county records are going to reflect the DST as the owner, the legal entity. They act, the sponsor, as the trustee of the trust. Somebody has to be in charge, kind of like the managing member of an LLC, but that's a very different legal structure. They now own this asset. Sometimes they'll hold it and operate it for some period of time. They essentially turn it into a security offering. In other words, they now go out to the individual broker-dealer network, financial advisors like myself, and raise that capital that they put into the property to pull it out. Their goal is to continue to find good assets, bring new investors in, and then eventually sell those assets and have a solution waiting for those same investors. And that could be 6, 7, 8 years down the line. That's the typical hold period or operational period. Banks love this. It's a single borrower, so they don't have to underwrite. Literally could be as many as 499 investors. It's a single investor. Any specific signatures required, guarantees required for that loan are signed by the sponsor, the trustee of the trust. So interestingly, as the investor, you're not directly on the loan. You have no recourse, as they call it. Bank doesn't even know who you are, strangely enough. They know who the sponsor is and they know the entity. This is just pieces of the entity that have been sold that are the equivalent of real estate and are the equivalent of debt, but it's not debt directly in your name. When you sell a property, just a quick 1031 basic recap, you have to buy equal or greater value of what you sold, net of expenses, inclusive of debt. So if you pay off a loan, let's say of $500,000, and you walk away with $500,000 cash, then you sold the property for about $1 million. Many investors think they just need to reinvest $500,000 because that's the money sitting with the accommodator, and that's not correct. You have to buy of equal or greater value, meaning $1 million or greater, in order to complete a tax deferral in a 1031. So you need that debt. This is a great way to get the debt that you need if you have to replace it, but again, without the underwriting and credit check and all of that stuff. I mentioned the 50 to 55%, below 60, let's call it at the most aggressive. I've seen 58 loan to value. That's important because in the high-flying days in the early mid-2000s, we were seeing for investment real estate, $100 million assets, literally 80+% leverage, like a homeowner. Very unusual for investment real estate. Obviously far too aggressive, and the values of those properties were also inflated. So you had a lot of debt chasing a lot of inflated value, and all the shenanigans on Wall Street, that's what led to the downturn and the debt crisis of 2008. Now we're seeing far more conservative leverage, the use of leverage in these DSTs, and in general. If you were to go out and buy a small apartment building, probably 35% at most down would be requested of your lender. Depends on a lot of moving parts. But in the DST world, very conservative leverage. So you're not coming into something with a lot of debt. The sponsor sells off what are technically called beneficial membership interests. Deeded interests isn't the right way to express it, but it's the equivalent of owning your share of the property again. They pass through 100% of your share of everything. And this is often, I joke in my seminars, but you already know the answers to the questions that are probably swimming in some of your heads. In other words, if there's a certain amount of cash flow that's distributable, and obviously investors, one of the reasons we invest in real estate is for that net cash flow. Whatever that dollar sum is of distributable cash flow, let's say you owned 1% of the DST, you would therefore be entitled to 1% of the cash flow. In other words, nobody's taking that share away from you. The expenses, which they control, they do a good job of managing and keeping as low as possible, but you need those expenses to write off on your taxes, just like you do now on your apartment building or your rental condo. It goes on your Schedule E, just like normal. And again, 100% of the 1% you own gets passed through to you. So this is very different than other investment vehicles, partnerships, REIT. This is true co-ownership. Depreciation, you've got your own depreciation schedule. You've already depreciated your asset. If you've held it many years, you've probably depreciated it pretty low. When you acquire this property, let's say you buy, I mentioned equal or greater value, you buy a bit more real estate. Well, you're able to claim that new adjusted basis depreciation because you traded up. In many cases, that happens with our DST investors, so they start enjoying a new schedule, a new depreciation schedule. These are 27.5-year straight line depreciation because they're residential, 39 years for commercial, but 100% of it passes through to the individual investors. You're not diluted. How many people are in this? Well, let me stress, you're not in partnership. The IRS will allow up to 499 members in a DST. But the reason I mention it, you don't even know who these folks are. You just all commonly own the same asset or assets. The reason I mention it is that the sponsor who put up that cash, they're able to raise money from many individuals, and therefore the investment minimum can be much lower. And that's another huge advantage of DSTs. If you have $500,000 in the example I gave, and you need to buy $1 million or greater in total value, well, you can now buy 2 or 3 or even 5 different DSTs with $100,000 in each one, or $250,000 in 2 of them. It's a great way to diversify your risk. Maybe you're in 2 different states, 2 different sponsor firms, 2 different asset classes potentially. One of the huge advantages is the ability to take relatively smaller amount of equity and spread it around to diversify your risk. And a lot of my more senior investors are looking for that, and ultimately they want to have their wealth pass on to their heirs. That's a whole other tax law conversation, but as the law stands now, any step up in basis that exists with all your assets now, the same would apply to the DST. So if you own your property in a trust, the trust owns an interest now in several DSTs, and when you pass on, your heirs receive, let's say 2 kids get 50% of the assets. They would each own 50% of the DSTs. It doesn't change anything, once again. The biggest draw, I often say the best thing about the Delaware Statutory Trust is also the worst thing about it, and it's the same thing, and that's the element of control. If you're an investor who's still active managing your properties, maybe you like doing some of the work yourself, or definitely hiring the vendors, because we know how challenging that can be. This may not be for you, and I'll be the first one to tell you that. You've probably heard the cliche by now. It's been used since the early 2000s about the 3 T's, avoiding toilets, tenants, termites. I want to add a 4th and call it teenagers. All those challenges with owning real estate, many of you have already experienced for many years. I've heard untold thousands of stories from clients and investors and prospects over the years. So I know the challenges. You've worked hard to amass this wealth and build up this value. But when you sell, if you want to avoid that pretty substantial tax bite, anywhere from right now over 1/3 of your gain, may even end up being over half your gain if the tax laws change unfavorably, you want to avoid that. You want to keep that wealth intact. However, you don't want to continue being active. You don't want to continue managing. Again, the good and the bad. So if you want to be in control, DSTs are probably not for you. But if you want to let go of that and really rely on experienced, seasoned, professional companies to take care of those things for you, your real estate in general, this could be a perfect solution. It is really, truly ideal in the sense that it is completely passive. There is no voting. There's no communication with the other investors. The sponsor, again, acts as the trustee, the responsible party, to oversee the property, minimize the expenses, maximize the income, And then usually the cycle is about 6 to 8 years. The time would be right to sell. And when that happens, you have once again the option to 1031 exchange just as you exchanged into it. You can go into another self-owned whole property. You can cash out and pay the tax. You can go to another DST, and you can stay with the same sponsor because they're going to have another DST waiting for you. And that's leading me to another really important point. You want to deal with sponsors that are well known, that are experienced, that are not doing this for the first time in the last 5 or 10 years. Frankly, everybody's a genius in the last 5 or 10 years in the investment world, right? Stock market's gone up dramatically. Real estate's gone up dramatically. You'd have to work really hard in the last 5 or 10 years to lose money in your investment. So you want to deal with companies that have worked through not only the 2007 recession, but the 2001 recession perhaps, or into the late 90s. So I'll speak to that in a moment. After 6 or 8 years, you have the option to sell. They'll sell the property. You have the option to exchange. But you may want to sell earlier, what I call an early exit. And the question of liquidity comes up. Adam, how can I get out of this thing if I need to in a year or two? Can I? It's a bit of a mixed answer, and I'll be as direct and honest as I can. Yes, you have the right, the legal right, the ability to sell your fractional ownership, your 1%. Most sponsors have built into their offering that all the other investors have a right of first refusal, so that you have to be able, right of first offer. I mix those two up. You have to show it that it's available to them first. You don't have to sell to them. They just get the opportunity to buy you out. And frankly, those are usually your best prospects to buy a 1% share in the DST. They already know the property. They've been receiving cash flow. They're already an accredited investor and obviously a real estate investor, so it makes sense that one of the other co-owners may buy you out. And whatever price you choose, it's not dictated to you. It's the same as any other real estate. I stress that again. Is there a secondary market? Is there liquidity? Is this a liquid investment? The SEC would tell you no. All real estate is illiquid. You always have the right to sell it and the ability to list it and name your price, but there's no market you can go to, push a button like a stock, and have a bid and an ask and immediately sell the asset. So this is an illiquid investment. And I tell folks, don't go into it planning on exiting early. These are investments for the longer term, and that's when you're going to maximize your results. But can you sell it? Yeah, if you find a buyer and they're willing to pay your price, you absolutely can. And I'll go further and tell you it's a very simple transaction and a very cost-efficient one, because there's no title or escrow or loan assumption or transfer tax. It's a very simple conveyance of this interest, this DST interest, so that if you're able to find a buyer, relatively low cost, you can get out and once again do another exchange, take the money and run, pay the tax. You have all the same options. Candidly, I can tell you through the Great Recession, and I've been in the industry, and my partner Bob has for literally 20 years plus, almost 30 in Bob's case. When the economy's been down, when we were in the 2007, 8, 9 period, it was tough. First of all, not a lot of people were interested in buying real estate, and those who were wanted to pay rock bottom prices. Lenders weren't crazy about it either, and in those days, some people did have a loan assumption. So it was a challenge. I can tell you that in the last 10 years, as I said, we're all doing pretty well, relatively speaking. People that have bought people out have been able to, with some ease, depending on the asset. They have been able to exit, and they have been able to get a good price for their early exit of their DST interest. But don't think of it as a liquid asset. It is an illiquid asset. It is not a parking vehicle. And it's very possible that you may want to sell early and nobody's willing to pay the price that you want. And there's no secondary market that you can go to sell your interest. So that's the liquidity portion. So let's remember a few things. I talk a lot about how many of you who've owned real estate over the years really already know a lot of the answers to the questions, but sometimes I think folks, particularly when they're learning, if this is new to you, the Delaware Trust, you need to be reminded of some basics. So let's bring up a couple of things to remember. First of all, who's the sponsor of the investment? Who's put this offering together? Who's managing it? Who's going to ultimately sell it? Well, that's what we call the sponsor. The track record of the sponsor matters. It's not a guarantee. You all know the expression, past results don't guarantee future results, and that's true. But you want to know that this is a company that's done this before and in fact has a goal of doing well with each cycle and then keeping those same investors in their next offering. In other words, they're in it for the long term. We work with companies, only about 5 or 6 out of 40 now, that offer DSTs. Why do we only work with those 5 or 6? First and foremost, because there's only 5 or 6 companies that have been around 20 plus years. We're very particular about that. We have literally in our practice hundreds and hundreds of investors with these same firms. New offerings every few months. As they sell out, they bring out new ones. But we know the companies, we know the players, we know the individuals, we know the track record. And of course, we want to educate you before you invest your money and rely on this sponsor company. Second thing to remember, it's real estate. Most basic thing in the world. People see these multi-million-dollar assets and think that it's something different or beyond real estate or a stock or what have you. It's ultimately real estate. What's held up the best, particularly through the tough times? Multifamily and self-storage. That's a fact. If you were to look up what happened during the Great Recession, Class A, meaning within 10 years of construction, multifamily, has truly held up the best. Folks that are paying higher rents generally have higher paying jobs and are able to weather the storm. We saw that last year with COVID, relatively minor impact on the Class A multifamily. Lower classes of real estate, more middle income folks, of course, they were dramatically affected both in the Great Recession and through COVID. Self-storage is another asset class in the Great Recession that actually increased on average its income, its revenue. It's the only asset class in investment real estate. Obviously, retail suffered, office as technology's advanced. There've been fewer and fewer tenants, and that's a challenge. But you have to live somewhere, you have to sleep somewhere, and as far as I know, you can't sleep on the internet yet. And you need to put your stuff somewhere, whether it's through a tough time where you need to relocate or a good time where you just have a lot of stuff. So these are the two asset classes we focus on. This is what we would argue is the most secure real estate, the most recession resistant. Where is the property located? Everybody was told by their mentor, their parent, the 3 rules of real estate, right? Location, location. I always forget the third one. Where's this property that you're buying located? I don't care if it's a great tenant. Maybe it's a single tenant CVS pharmacy and you like CVS's creditworthiness. Where is it located? Because should that tenant vacate or go dark, meaning move out, or finish their lease and move out, that often happens, you still own a building located somewhere. Is it a good location? Are people moving there? Are tenants looking for the properties that are there? A lot of folks, I think, lose sight of that as well. You want to be in the multifamily world, in the self-storage world, again, more affluent areas, growth parts of the country where people are moving, where companies are moving, where jobs are moving. And I can tell you right now, that's Florida, Texas, Arizona, up through the south. Absolutely. Georgia, North Carolina, South Carolina, Tennessee, Virginia. And of course, the DC area is always pretty solid with government-related employment. These are the areas of the country in general where you're seeing the most positive job and population growth. We just had the census, as many of you heard. California lost a member of Congress as a result. Texas and Arizona gained. Now, that doesn't mean everyone's moving out of California. I do hear that a lot. We're actually in Southern California just recently crossed over to a net negative number where we're not growing. But I can tell you up until about 2018, we've had positive growth every year in the history of this city. The reality is we're so large now that it's very hard to continue that positive growth. As a result, and with legislation and regulation and people wanting to get to a non-tax state and so forth, sure, a lot of folks are moving out. But we're still bringing in new babies. We still have immigration, which of course slowed again during COVID. Still very strong, expensive real estate in Southern California, Northern California, as well as the Northeast. Lastly, the demographics. I mentioned location. Well, that implies where are the jobs, where are people moving. You want to look at that, whatever you're looking to invest in, and certainly in a DST. And all that's provided to you, all this due diligence and information I'm talking about, has already been done. And it's available to investors through a private offering. You can also look at the individual due diligence materials, things like a third-party appraisal from an unrelated party doing an appraisal of the value of the property, which the lender orders. The property condition report. Engineers look at the property. What is it going to need in the next 10 years? What reserves should be set aside? All of this kind of demographic study is done before it ever reaches your desk. In fact, before it reaches my desk, so that while they're not guaranteed, they have been reviewed. I always say a lot of eyeballs have been on these properties, these DSTs. So that's the end of my talking portion. I think you might have a few questions. I know you can use the chat box. I think Jeff's going to help us go through some Q&A. But if you want to see some examples of Delaware statutory trust properties, if you're contemplating selling and you want to understand this better and maybe it's 6 months off, give us a call. Give me a call. There's a toll-free number there, and I think you can call me direct in my office, and they'll pop that up in a moment to reach me. Again, my name's Adam Bryan with H&S Wealth Management. This is our team. My partner Bob is the gentleman on the left there. Let us know if we can help you out. It's really a question of what works best for you. What are you trying to accomplish? And we want to help you accomplish those goals. And with that, I think I'll hand it back to Jeff for Q&A.
Great. Thank you so much, Adam, for that. Love it. Every time. It's always great. We do have questions already, but if you hopped on late, do want to mention that Dan Fowler talked about the largest protest ever. So you're going to want to go back to the beginning of the video after everything is done. Go back to the beginning of the video and watch that, just in case you missed it. And we're going to get started. Now, H. Wallach, he asked a question and then he clarified it. So I'm going to I'm just going to read both of them, and let's see what you think. Adam, all right?
Mm-hmm.
Okay. So he has explained depreciation recapture if 1031 done incorrectly. And then to clarify my question, the building I sell for $3 million, vacant land costs $3 million plus $1. So that's what he has to clarify there. Does that make sense?
Kinda. I'll take a shot at it.
Yeah.
Sounds like a fairly complex question. Firstly, let me preface, I'm not a CPA or a tax accountant, although I have dealt with these issues and I certainly know the impact on a 1031 exchange into a DST. Generally speaking, what's called improvement, which is what most people would say the building, can be depreciated generally on a 27.5-year schedule for residential property and 39 years for commercial property. Raw land, which you mentioned in your question, cannot be depreciated. Now, this is significant for a lot of reasons, but the bottom line is the way depreciation works is the IRS wants you to take that straight line 27.5 or 39-year depreciation every year. In fact, even if you didn't, which no sane investor would not do, you're going to be taxed on the recapture even if you didn't claim the recapture. Kind of a strange quirk in the law, which means if you are paying tax and not doing a 1031 exchange, they're going to look at the value of your real estate, your basis when you bought it, and you depreciated it over the period of time you owned it. Again, on a 27.5 or 39-year schedule. And whatever that end sum of depreciation is subject to tax. You got $100,000 in, let's say, in depreciation over the years. You now owe 25% or $25,000 in depreciation recapture. So you get the benefit of it while you own it. You write it against your income, but you have to pay it when you end up paying the tax back to the government. So again, in your example, I'm a little unclear, but you mentioned land, and there is no depreciation of land. And in fact, that hurts depreciation opportunity in higher value areas like Southern California. Why? Because if you have $1 million property, half the value could be in the land itself, and the other half is in the building, right? So you're able to depreciate that $500,000 in my example. That same property, that exact same property in North Carolina may have 10% of the land be the value of the property, the $1 million, 90% the improvement. And that's because the land values are so much lower out of state. As a result, you're able to depreciate, in my example there, $900,000 because that's the value that's depreciable. I hope that answers your question. Give me a call or send us an email so I can follow up on your specific issue, but hopefully that answers your question.
Great. Thanks, Adam. All right, Jay Barry, I understand that I might be able to combine 1031 gain and 121 gain on a single residential property. Can you explain to me how that works?
Yeah, so the 121 he's referring to is the IRS exemption for your personal residence. Without going into the history of the 80s, when you sort of exchanged your homes, you might remember that if you're a little older. Right now, the government says that when you sell the property you live in, your residence, the first $250,000 per person if you're have a spouse, so 500,000, is not subject to tax, period. And anything above that, you're not able to exchange because it wasn't a property held for investment purposes, so you can't do a 1031, and you're going to be subject to capital gains tax, just like if you sold stock. But most people, their gain is less than 500,000, so when they sell their home, whether they're buying another home or not, they're able to defer, or not defer the tax, but actually eliminate the tax because the gain is less than 500. I'm pretty sure what the Jay Barry is asking is, what if I have a property that I live in, a duplex, and I have a tenant who lives in the other unit? And that's a very common situation amongst investors I deal with. The answer is, let's say it's an even split of land and square footage of the properties, if that in a perfect scenario. So if you sold that property for $1 million, $500,000 of it is your residence, 50%, half is an investment property. You would be able to claim the 121 exemption if you're married for that 500,000 exemption of tax on your personal residence. So 500,000 you get to keep, probably use towards your next home. The other 500,000 you can 1031 exchange, just like any other investment property. And that's how you're able to combine the two.
Great. All right. And then Marie, I think she may have caught a typo. Is there a typo on the 1031 in Delaware Statutory Trust? The slideshow shows that we must identify the property within 45 days and sell within 1,080 days.
Okay. A couple of things, Marie. First of all, 1031 rules and DSTs are two completely different issues. Just think of a DST as a type of property that you buy, just like any other property. 1031 IRS code gives some rules as to how you defer the tax. I don't believe there was a typo. Maybe there was. I'll go back and check. The IRS 1031 code says that when you sell an investment property, you have from the day you close escrow to 45 days to name specifically what you're going to acquire, what you plan to. And there are several rules for that nomination. The 3-property rule is the most common that people use. There's a couple of other opportunities to nominate even more properties. You have to actually close in 180 days, almost 6 months, on the properties you've identified or the property you identified. Those are the basic 1031 rules. DST would just be another type of asset if you are nominating that you're able to put down as one of your nominations. I will say, you didn't ask the question, but it reminds me, another advantage of DSTs is that they're already closed. Remember I said that the sponsor owns the property, has the loan in place. They're just selling off interests to you, the investor. What that means is that if you know you're going to do an exchange, you get comfortable with the concept of a DST, maybe we've sat down and met or talked, you've picked a DST or BSTs that we've recommended, well, you can often close within a week of the sale of your property, the relinquished property, which is a great way to keep your cash flow coming in, keep your money working for you, avoid any issues with nomination, because if you close before the 45 days, you don't need to nominate. You only have to nominate if you haven't identified and or purchased what you're going to buy. But we'll check the slide, but I'm pretty sure it should be 180 days and 45 days.
Great. And Alexandra on YouTube, what is the difference between a DST and a syndication?
Great question. I get that a lot. Probably, Alexandra, you've been around a little while. Particularly in the 90s and 80s, there were some tax law changes that created opportunities for usually what are called limited partnerships or partnerships, and they would often be referred to as syndications. So a company goes out, raises money from individual investors, kind of acts as the head of the group, if you will, buys the property, manages it, and sells it. The difference is if that process I just described is done in a partnership, as it usually is, the sponsor or the syndicator is allowed to do different things. They can keep, for example, some of the profit. Many times they would have these types of offerings and say, when we sell this property, we're going to get 20% of the profit. That's a reward for us doing a good job. Investors, you're going to get 80%. And there's nothing wrong with that. That's a very common deal structure. They call it a waterfall. The point is, in a DST, that is not permitted. The IRS did not want this to be a legal entity like a partnership or an LLC. Often in syndications, they were done, again, in those legal structures. Nowadays, we wouldn't really even use the term syndicator if you're a DST sponsor. Effectively, though, it's the same concept of you're relying on a third party to bring you good real estate. You invest in it with your money, they manage it, and then they handle distributions of the cash flow, tax documents that you need to file your returns, and profit upon sale, hopefully. That's the main difference.
Great. Sam Wong, thank you for your question. Is the property in a different is the property are in a different state? Does it mean we have to file income tax for that state each year?
Sam, that's a great question. Again, I got to qualify it. I'm not a CPA or a tax accountant, but I've been doing this many years. Most accountants, I'll answer your question that way. Most accountants and tax professionals will say yes. If you're in a state that has income tax, Texas, Florida, Nevada do not. But if you are, that the state would want you, because you earned your income in their state, to file a tax return. Now, I'll tell you the good news. California is the highest tax state in the nation, unfortunately. And what that means is if, let's say, you own a property in Georgia and you earned X amount of income, you need to file a Georgia return. That may cost you $100 or $200 with your tax preparer. And you need to pay the state of Georgia the income tax on the income you derived from that investment. But that income tax is guaranteed going to be less than than California. So in other words, let's say you paid the state of Georgia 6% in taxes. Well, you now are going to file, because you're a resident of California, your California return, and you're going to say, I earned this income in Georgia, but I already paid 6% to the state of Georgia. I owe the state of California 10%, but I'm going to get a credit of that 6% and pay the difference. So in other words, you're not going to be double taxed. I think a lot of people worry about that. You're going to pay the same amount of tax based on your state of residence, but you may have to pay it to two different taxing entities.
Great. And then we have a question from Munir, and thanks for joining us again. And it is, what is the riskiest DST?
Ooh, that's a loaded question.
And why?
Wow. All investment real estate, including DSTs, have risks, so let me qualify my statement with that. I'll give you just from the heart, honest answer, and the way I look at properties and investments for my clients, honestly, I look at it as if it were my money or my parents' money. It's just the way I operate. It makes the most sense. And so I do avoid a lot of different types of DSTs, and I don't recommend a lot of real estate. I would argue, and this is purely opinion, that single tenant property, commercial investment property, that has less than 15 years remaining on the lease, and the fewer years remaining on that initial lease term, the worse it gets. Because you're going to be selling it in 5 or 10 years perhaps, in which case there's going to be even less time remaining on the lease when you go to sell. So therefore, you don't want to be in a property that's arguably worth quite a bit less when you go to sell than when you bought it. You want it to appreciate, not depreciate. And single tenant properties tend to almost always depreciate. So I would argue a weaker tenant, obviously you never know what a weak tenant is these days. Sears and Roebuck, over 100 years in business, went
Right.
PK. My kid's favorite restaurant, Soup Plantation, went into default and closed down. So you never really know. But the bottom line is, when you're involved in the office world, companies, the retail world, certainly with the internet happening, even the pharmacies, again, that are well known, Walgreens, CVS, I believe that's going to be taken over probably by Amazon, just like everything else was taken over by Amazon. So honestly, I think commercial property, short lease term remaining, that's key. And also, once again, location, not to make my joke again, but location. Where is it located? Because you may end up owning a building in a horrible location and you may need to re-tenant. There are DSTs out there that will pull together various single-tenant, triple-net properties. We'll look at them. But if the credit worthiness isn't there, if the lease term isn't there, and if the location isn't there, we won't recommend them to our clients. And so I would argue that's probably the riskiest. There may be more risky, but that's what I would avoid first and foremost.
It sounds like you're bullish on multifamily housing.
You know, a lot of us made our money in residential and multifamily apartments, duplexes. Once again, people have to live somewhere. There's just no way to replace that. And as long as there's growth in a market and jobs, you're going to have people. Things can slow down a little. We all lived through that in the Great Recession. But I ask the members, when we went through those years, 2007, 8, 9, you didn't really lower your rents, did you? You just left them flat, right? Well, that's one of the advantages of investment real estate that has month-to-month type lease terms after the first initial term of 6 months or a year. And when the rents started climbing up in the last 10 years, really in the last 5 years, your rents have gone up for new tenants. And hopefully you've kept up rents with your existing tenants, although I know many of you don't. But the bottom line is you have that flexibility with residential. And actually self-storage has some similarities in that respect. You can keep up with the market. When it goes up, you go up. When it's flat, when it goes down, you stay flat.
All right. Irina, how COVID affected cash flow with DST?
Yeah. Irina, that's a great question. It's my favorite one because I get to be right and I didn't know I was going to be right. So I've been talking about Class A multifamily, and again, I stress Class A for many years because that's what held up through the recession. Everybody got affected in the Great Recession. I got affected, you did. But it kind of works from the bottom up. You know, they talk about trickle down economics, it's trickle up. Unfortunately, people in lower income jobs get affected first and hardest. And then eventually, in the case of the Great Recession, mortgage people, real estate related industries, ultimately everybody had an impact. But it always starts at the bottom, if you will. COVID, I didn't know was going to happen. I'm not nearly that smart. But interestingly, very much like the recession, the same thing happened. The folks that couldn't work, through no fault of their own, hairdressers, bartenders, waiters and waitresses, in many cases factory workers, lower income jobs, well, they were impacted dramatically. I've heard some numbers. I can't back them up with the study, but in general, I've heard that collection rates dropped as much as 30+% during the COVID period at its worst point for residential rentals or multifamily. 40 to 60% collection rate or 40% delinquency for retail and restaurants. Well, in the asset classes that Bob and I work with the most at H&S Wealth Management, the Class A multifamily, we saw maybe a point or two. Certainly there was some impact, particularly in the Las Vegas market we saw that. But generally it fared extremely well. And why is that? Those higher income folks that I'm talking about who rent the most expensive new luxury apartment in town have enough money, number one, and maybe they're even renters by choice. Number two, and more importantly, with technology, as we all know, you can do a lot remote these days. And they have the types of jobs you can do remote, i.e. a waiter or a haircut person, etc. They're not able to work remotely. And as a result, the Class A multifamily had very minor impact that we saw, which I'm very pleased about. But again, I couldn't have guessed that it would have been a pandemic that would have tested our practice.
Great. All right. Edward Choi, thank you for your question. Is there a typical HUD-1 for a DST transaction?
The HUD-1, I'm not as familiar with that document, so I don't want to speak out of turn, but I think it's going to qualify just like any other multifamily would. So if that's something you're normally receiving in a property purchase, it wouldn't be any different with a DST. These loans that I mentioned for residential, they are Freddie Mac backed loans, often through local banks and lenders. So again, whatever the normal requirements and documentation occurs, it wouldn't be any different with the DST. But I can't speak to that specific form, so I'm going to leave my answer there.
All right. Here we have, go back to the top. Yeah, let's see. Mr. Wallach again. I can't get the rental house built within 180 days.
So that's a kind of fractionalized question. I can't get the rental house built.
Yeah.
So there is an opportunity called a reverse exchange to go out and buy some land with your own money, maybe even build something and do what's called a reverse exchange. In that example, you haven't yet sold the down leg, the property that you are exchanging. That's why it's called a reverse exchange. You're buying first. That means a couple of things. You have to have the money to do it because you don't have the money from the sale of your existing property, first of all. You can't do it in your own name, so there is a need for a third party to take title, in this case, to the land, and you do that through your accommodator. They will then create a legal entity, which really is you, but for tax purposes is not you, and hold title to that land. And then it sounds like you want to build something on that land, and you can do that. But if you're doing an exchange, whenever you sell that initial first property, you have to, remember, nominate and reinvest in 180 days. And many people are having trouble getting construction done now. Another reason for the challenges in the real estate market and the values appreciating. So if you're not able to complete construction in that reverse exchange within 180 days, then the money from your sale of that initial down leg property can't be used basically to pull your own money out of that new property. It does need to be completed in 180 days.
Great. I think you hit it.
I think that's what H. Wallach is saying. I hope so. Again, call me and email me if that doesn't answer your question.
And Munir on YouTube, what would happen if the sponsor goes bankrupt?
Ooh, good question. And there were challenges through the Great Recession with some sponsor firms. Because of the nature of the structure of these deals, as I've mentioned before, truly it's co-ownership. It's just like you and I are in a property 50-50, and we have a third party managing it and taking care of it. What would happen to our property if that third party went under or went BK? And the answer is, I can't say nothing, but very little, because it doesn't impact the property directly. What would happen if that were to occur is that another trustee would need to come in, whether it's through a bankruptcy court, if the sponsor's gone bankrupt or what have you. Someone would need to take control and be essentially the asset manager, the trustee of the trust, the coordinator of all the investors, and obviously the overseer of the property. So another party would come in, and if we are looking at a BK scenario, then obviously a court-appointed receiver would become the trustee of the trust. But with regard to what happens to the property, assuming the property management's still there, the bills are paid, everything's going on, the sponsor is just having its own separate financial challenges, I can honestly say nothing. There's no reason for there to be a direct impact. There could be, and there's going to be a period of uncertainty with who's going to take over the management, but once that's resolved, the property stands on its own.
All right. Okay. Alexandra, what kind of return do you get with a DST and with syndication?
Thank you, Alexandra. I appreciate that question more than you can know, because I had it in my presentation and it just occurred to me. I don't think I ever uttered the words. So the cash on cash return is, and just to be clear, you put in $100,000 into a DST with or without a loan, you're going to get a return based on the equity you put in. And right now, with loan rates being low, but leverage also being low, and more importantly, prices being exceptionally high, we're seeing about 4.5% to 5% cash on cash. So that means $100,000, you would get $4,500 to $5,000 a year in income. That income is distributed monthly. And depending on your own depreciation schedule, you would be able to shelter quite a bit of that income along with the usual expenses and everything that went into. That's a net cash on cash after the expenses, but it's all reported to the IRS, and then you claim your depreciation. The gentleman earlier that asked about land, by the way, if he were to take his land sale, he had no depreciation, and acquire a DST, well, now suddenly he has a great deal that he or she could depreciate. The return upon exit, which is another way to answer your question, well, it's an unknown. I can't tell you exactly what's going to happen any more than I can tell you what the stock market's going to do next week. What I can tell you is if it's a sponsor who's been around, and by around I mean 10 to 50 years, in one case 52 years this year, they have a track record. They have a documented record of every acquisition, purchase price and date, sale price and date. And I'm going to share that with you with any investment that you're looking at, because again, I want you to know who these sponsors are and what their track record is. They range around nearly double digit per annum. In other words, people on average, and that, by the way, this is going through a very long time period. If we just looked at since the Great Recession, everybody's done phenomenally well. That doesn't mean anything, though. If we just looked at the Great Recession in the last few years, over 10, 15 years ago, everybody had some challenges. The multifamily held up, but there were certainly some properties that even sold for less than they were acquired in the worst case scenario. The answer, though, is if you look at the overall average from these sponsors who've been around, most of them have been able to throw off, call it 4, 5, 6% cash on cash during the hold, and another 4, 5, 6% appreciation per year. So an annualized or IRR of around 10%. Some are closer to 8, 9%. Very few are far north of 10, 11, 12%. basically they've done like the overall real estate market, maybe a little better, maybe a little worse. But that's been the history of the various sponsors. I'm speaking generally now. We can look at specific ones in the future if you're looking at a specific company and investment. But that's been the usual, if you will, for the average period of time. And by the way, I do think we're kind of going into that average period of time. In other words, I don't see very strong appreciation in general, just simply because our prices are so high, just like I talked about in Southern California. I also, by the way, don't see a huge drop in values. At this point, there's so much equity in these deals. Employment's coming back. We obviously had a huge hiccup. Interest rates are being kept low, artificially low, some could argue, but nonetheless they are, and inflation has not really kicked in with the exception of recovery from COVID. So therefore, I kind of feel like things are going to be a little bit flat, kind of like they've been. And incidentally, since I became much more active after about 2013, because the market picked up, I've frankly been saying the same thing, and it just keeps slowly happening. At some point I'll be wrong, but I do think it has a lot to do with the way the government's managing interest rates and keeping the overnight rate low. That may have some serious consequences in the future, but if it does, it means inflation. And again, with multifamily and self-storage, it means you can raise your rents, which is why I stick with those asset classes. I hope that answers your question.
Great. Thanks, Adam. All right. As a future DST state shareholder, this is Munir again, and as a future DST stakeholder of a DST property, will there be any shareholders meetings? Will we get to vote on a decision?
Munir, without going into a long history lesson, there was another form of co-ownership some of you may have heard of called TICs or TICs that were much more popular prior to the Great Recession. And in that deal structure, there were many disadvantages to it and differences with the DST. I won't enumerate them, but to answer your question directly, a vote was required among the co-owners to make major decisions like refinance, sell, don't sell. Horrible idea and created a lot of challenges for those properties. Why? Because I can't get my family to agree on where to go to dinner. How are 35 investors all across the country going to agree on a major decision about their wealth? The answer is no. In the DST structure, the sponsor is the trustee of the trust. They're responsible to make those decisions. Do they advise clients and let them know what's happening? Absolutely. Quarterly reporting, annual reports. They have investor relations departments. They want to take good care of the investors. They want to maximize the value. So you're definitely in the loop of what's happening on a property. When there's been storms, none of them, by the way, because of insurance and the quality of the real estate, have actually been affected by any of these major hurricanes. I know a lot of people are worried because we have a lot of Florida properties come up. They actually hold up quite well. But there's always communication going out to the investors. And when a big decision like maybe we should sell this asset has to be made, the sponsor's going to make that decision, not the individual investors, not through a vote. You remember I said the best thing and the worst thing is control. This is an area where you're giving up control. I would argue you wouldn't really have control if it were a voting situation anyway. And frankly, the sponsor's going to do the right thing for the real estate, which is the right thing for all the investors in turn. But ultimately, never is there a vote in a DST.
Now, how does the sponsor, what's in it for the sponsor company? How are they incentivized to make this work for,
Thank you, Jeff.
for the investor?
Good question. They make their money on the buy and the sell. I put that very simply. The sponsor I mentioned at the beginning is going to go out and acquire, let's say, a $100 million asset. They're going to do all their work. They've already scoured the country, et cetera. They bought the property. Now they're going to package it up and sell it to you, the 1031 exchange investor. They're going to add about 2, maybe even 3 percentage points increase. That's called an acquisition fee. So there is no, remember I said earlier you can take a share of the profit if you're the syndicator. Well, they're not allowed to do that, remember. But they can charge a standard fee, which in this case would be around 2%, 3% would be on the high side. I've seen less than 2. So you're going to buy that $100 million property for $102 million or what have you. When the property sells in the future, we don't know when, depends on market conditions, but the sponsor will sell it probably 6 to 8 years down the line. Well, they effectively have the listing tied up. They just don't call it the listing, they call it the disposition fee. So they know that when they buy the property, they're going to make their profit, if you will, and when they sell the property, they're going to make their profit, that disposition fee. Many people worry during the hold that they're using the investment as a cash flow vehicle for the sponsor. truthfully, they're not. It's not a profit center. They want to make sure the property is well managed during the hold, but ultimately that's not where they make money. They just cover the costs and the expenses, make sure reporting goes out, make sure there's people there to answer the phone and help you. But when they acquire the property and when they sell the property, and all the costs that, all the things affiliated with any kind of real estate acquisition are rolled into the numbers I'm saying, that acquisition fee, that markup of 2 or 3%, the fee that's paid to the broker, the agent. In this case, it would be the financial advisor, myself. It's all built into that price. The property management, which they want to keep low in market rates, all is before you see the, as I said, 4.5%, 5% cash flow, 4.5%, 6% appreciation. That's after all of those expenses. And that's fully transparent to the investors. It's well documented and made very clear both when you acquire the property through a private placement memorandum or an offering document, and when they sell, all the costs and expenses are revealed to the investors. You do have a right to know what's happening on your real estate.
As I was driving in this morning, I heard the tragic news about a 12-story building in Florida collapsing. And one of Alexandra, she has that question: what would happen to one's investment if an apartment building such as the one that collapsed in Florida were a DST?
Yeah, terrible tragedy. I often point out to folks that, in this kind of investment, really in any investment, but who's the biggest investor? Of course, it's our money. We think it's us. It's not. It's the lender. So the lender has perhaps a 45%, 55% stake in the property. They're going to be darn sure that if something, God forbid, happened to the property, that they're going to get that loan repaid. That's why we all have to have fire insurance on our homes. Well, the same is true in this type of institutional real estate. They're fully insured for things like act of God, hurricane, flood, which is actually the bigger concern. These buildings I sell, the investments we work with, they don't blow away. They're not impacted by even 500-mile-an-hour winds. Flooding can be a challenge, but they do studies on how high up they are and so forth. But if, unfortunately, there was an impact on the property, and again, there's been many hurricanes in Florida that's crawled up the coast, Houston as well, a couple of things are going to happen. There'll be an expense for the deductible, just as always, but that money's usually already sitting in reserves when you acquired the property. They're going to have a claim, and they'll have what's called replacement value. Anything that's destroyed would be replaced. So in the end, ironically, you're going to end up with a newer, nicer structure if it had to be rebuilt in the same location. But I'll go you a step further. Most investors on their own real estate, their own small apartment buildings, don't have rental income replacement insurance. And what you'll find with rebuilding, with insurance claims and so forth, a lot of time can pass. It could be even years to get back to where you were prior to the damage. As a result, you want to know that you have that cash flow that you lost, right, if everybody had to move out. So all of the DSTs we work with have blanket policies for their properties and individual assets that will make sure that they'll be returned to replacement value, first of all, with any damage. And secondly, that the income will go at least for a year, sometimes longer, to make sure that that cash flow is consistent. So as horrible as it is to say, that's really not the worst thing that can happen. The only big problem would be if, for example, you were in New Orleans with Katrina. If the whole market was genuinely impacted by a disaster event, then even when you get your property back in shape, well, the market has to come back. And that was a challenge for New Orleans. I have no involvement, nor am I even aware of any DSTs that were in New Orleans, because it is a well-known risk market in the lower regions of that city. So that's a consideration when they buy properties, particularly in Florida, which has been so hurricane-prone of late.
Great. And we'll just take one last question here.
All right.
This is from Sam Wong. When the DST is sold at the end of the 8 to 10 years, can I do a 1031 exchange to a residential rental property of another DST?
Yeah, you have, Sam, when the property sells, you have all the same options that you do when you went into it or when you're doing any 1031 exchange. The sponsor will let you know months in advance, typically, that the property's either listed or that they're under contract, they got an unsolicited offer, whatever the case may be. So you're going to know well in advance. They're going to give you time and ask where to send your proceeds, your profit, hopefully, at the end of the day, to what accommodator or to you if you plan on paying tax. Once that happens, The sponsors that I work with, at least, are going to have another option. They always like to have one in the wings because they want to keep your business. That's their business model. I have clients that have rolled over with me with different sponsors, I think 4 times is the record. People that are in these, I can honestly tell you, even in the bad times, they end up liking the experience. It is a positive one. The returns are reasonable and solid. Somebody else took care of all the headaches. Again, that's a big selling point. But the answer to your question is, you can go, once that money moves from the sale of your DST to your accommodator, you can buy your own real estate again. You can buy another DST from another sponsor. You can buy anything that qualifies under 1031. You have all the same options that you do when you sell your real estate today and want to do an exchange.
Great, Adam. Thank you so much
Thanks,
for your
sir.
time. As always, it's a pleasure. Any parting words for us?
Just, I want to thank, first of all, you and your dad and Sara. We've had a 20-year plus relationship with AOA. It's very symbiotic, very positive. We've been doing this for a very long time between my partner and I, and our goal really is to help clients realize their goals and help them achieve those things, whether it's I need to see a regular check, ideally, I know there's risk, whether it's I want to see something that's going to appreciate, whether it's I just want to get out of, I don't want to talk to another tenant as long as I live. We want to help you realize that. And if you're not ready now, and many clients start thinking about this many years in advance sometimes, that's fine. Give us a call. We'll give you a consultation, look at your situation, and make our best recommendation, and we'll try our best to keep you safe.
Great. And then one final question. What area do you cover anyway?
What area, meaning?
In the state of California, what area
My
do you
clients?
service? Yeah.
I'm actually licensed in many states, so I cover most parts of the country. I will say most of our clients do come from the Bay Area and Southern California in general. I find myself, I was in Las Vegas on a plane I didn't fly, pardon me, I drove. I've been to Las Vegas to visit clients, I've been to San Diego, I've been up to the Bay Area. We've also done some AOA seminars in the Bay Area. And occasionally I have clients that I work with even on the East Coast, mostly over the phone. But pretty much we can handle just about anybody anywhere in the continental U.S.
Great. Good to know. Well, hey, everyone, thank you so much for joining. Don't forget that we have Dennis Block on, especially for those of you that are in Southern California. As you know, the LA eviction moratorium was extended to September 30th. That's a 3-month extension. We're waiting to see what will happen for the whole state. So you can get a legal update from Dennis Block. That'll be great. And then next week, we'll have Carla Dennis, who's great. She'll show you how to save money and give less to Uncle Sam, keep more in your pocket. That'll be an excellent time. She's dynamic. If you haven't heard her, if you haven't been to the $1 Million Trade Show and heard her before, you're going to want to at least tune in for that event. And always you can subscribe to the YouTube, and then you also can go to AOAUSA.com and look at the events, and you'll see what's upcoming and register for them. The AOA USA, we have a channel on YouTube, so if you go to that channel, you can see all of the past events, or most of them anyway. A few of them we do pull down, and we want to reserve those just for members, like we did last week. We did one, and a few weeks back there was a pathway to wealth and just how to organize your properties to leave a legacy. And so some of those we do take down, and we will be making those available just for members later on. And anyway, so if you're not a member, please join. You get a money back guarantee if it's your first time. So there's really nothing to lose. You get the magazine. You can call in for property management advice. There's a tenant screening that's at a low cost. That starts at like $8.50, and super comprehensive. Lots of different benefits, and the group insurance again. Like there was a live stream last week, so you could go back and look at that one. And again, we're trying to find you, if we have an affiliate like that with the insurance company where we have a group insurance, we're going to find something that is going to be the best bargain where you get the most value for your money. And it may not always be the cheapest thing, but it's going to be, in the end, what's best. And group insurance is definitely one of those. It is low cost, and when you go to make a claim, you'll be happy if you come into that unfortunate circumstance. But anyway, thanks again, everyone, and we'll see you here in the afternoon. Bye-bye.